back to NoBroker's YouTube channel, your go-to source for everything around the real estate market. Today we are diving deep into the world of banking rates and understanding the critical differences between the bank rate and repo rate. These are the two fundamental tools used by central banks to control cash flows in a market, and they play a crucial role in shaping the economic landscape. Hi, this is Yoshu. Before we get into the video, do subscribe to our channel and hit the bell icon for future updates. Now, without any further ado, let's get started. First up, we have the repo rate. This is the interest rate at which a country's central bank, like the Reserve Bank of India (RBI), lends money to commercial banks or financial institutes during monetary emergencies. When a bank faces financial challenges, they turn to the central bank for loans, and the repo rate comes into play. In simple terms, commercial banks borrow money from the central bank through methods such as selling bonds or securities with an agreement to repurchase them at a specified date and price. The interest charged by the central bank on this borrowed cash is what we call the repo rate. Moving on to the bank rate. This is the interest rate at which the central bank lends money to domestic banks. Unlike the repo rate, bank rate loans are typically short-term and don't involve repurchasing agreements, securities, or collateral. The bank rate is usually higher than the repo rate. This means that when bank is borrowing money from the RBI at the bank rate, the cost of borrowing for the bank is higher. Usually, this cost is balanced by the domestic bank by lending money to the customers at a higher rate. Now, let's break down the key differences between repo rate and bank rate. First is collateral. Repo rate loan requires collateral like bond papers and government securities, while bank rate loans are unsecured. Second is tenure. Repo rate loans have a short tenure, often within 1 day, whereas bank rate loans typically span around 28 days. Third is the loan type. Both rates are lending rates, but banks pay interest on loans at the bank rate, whereas the repo rate is the rate at which banks pay the central bank to buy securities. Next is interest rate. Bank rate is higher than the repo rate, typically measured in basis points (BPS). 1 basis point is 1 by 100 of 1%. Next is objective. Bank rate serves long-term monetary goals, while repo rate addresses short-term financial needs. Now let's connect the dots between what we have learnt about repo rates and bank rates and how they impact everyday folks like you and me, especially when it comes to loans. Picture this. The RBI decides to cut down the repo rate. What does that mean for the common man? Well, when commercial banks get access to cheaper funds through lower repo rates, they tend to pass on these savings to borrowers like you. So, if you're paying off a home loan or a car loan, this is a great news. Your monthly installments become lighter on your wallet. But let's not forget the other side of the coin. If the central bank decides to raise interest rates, your loan repayment could become a bit heavier. It's not all bad news though. Higher interest rates are often a sign that the economy is heating up, which can lead to more job opportunities and wage increases down the road. As of 10th August 2023, the repo rate stands at 6.5%, while the bank rate stands at 6.75%. Any changes in these rates can impact borrowing costs and liquidity in the financial system. To sum it up, understanding the difference between bank rate and repo rate is essential for anyone interested in finance and economics. These rates play a pivotal role in shaping a country's monetary policy and influencing economic outcomes. Well, that's it for today's episode on bank rate versus repo rate. If you found this video informative, don't forget to hit the like button, subscribe to NoBroker for more financial insights, and share this video with your fellow finance enthusiasts. Thanks for joining us, and we will see you in the next video.